What is the long-term rates driven by? Yeah.
Yeah, that's a great question. It's a story of like a thousand papers. So basically it boils down. So you have a couple of schools of thought here. People think of it, it's just the market's expectation of what the path of the short-term rates are. Uh, that could be, but most people think of it as just supply and demand. It's really basic. On the supply side, you have the U.S. Treasury. How much deficit spending are they going to do? And where are they going to issue debt? You can do a whole bunch of deficit spending and then just issue debt, let's say 3-month debt or 6-month debt in the money markets, and that's not going to affect the 10-year at all. Or let's say you can do $1 trillion in deficit spending and issue a whole bunch of 10-year treasuries. That surge in supply is going to push the rates higher. So that's the supply side of what happens. But just to be clear, so that's treasuries only, but treasuries and other markets are very much intertwined. So for example, let's say there's a huge refi boom or maybe another huge housing boom, and there's a lot of agency MBS that gets issued. A whole bunch of people take up mortgages, they go to buy their house. Fannie Mae securitizes those mortgages and they get sold onto the market. A huge surge in like other comparable assets also puts upward pressure on all interest rates. Because a lot of people decide between whether or not I should buy treasuries or agency MBS, right? So this whole interest rate market is related. So it's a supply of what we'd say duration in the market. On the demand side, it's basically who's buying treasuries.
Yeah.
So when you're talking about 10-year treasuries, it's a really, really special asset because treasuries are, if you really think of it, a 10-year treasury is basically just like $1 billion in treasuries is like $1 billion bill that pays interest. I say that because we don't usually think of it that way, but if you have a dollar bill, it's printed by the government. If you have a U.S. Treasury, also printed by the government, there's no credit risk. It's also very liquid. And so there's a huge range of investors in the world who think that way. If you're a $1 billion asset manager and you have a bunch of cash, you can't just put it in JP Morgan, right? That's a lot of credit risk. People can't take that. And so you buy treasuries. And it's the same for, let's say, if you're a huge sovereign fund, like People's Bank of China, you have like $3 trillion. You can't just put that in the bank. You have to put that in treasuries. So the demand for treasuries is global and very strong. Part of it is regulatory as well. The government forces a lot of investors to buy treasuries as safe assets. So it's that interaction between supply and demand that makes that steers rates. Now, holding that all constant, there's the Fed. And I say the Fed now because the Fed, until very recently, was buying like $80 billion of treasuries a month. And that's a very big source of demand that's basically going away. So when that demand goes away and you have even more issuance coming out, this year, the US Treasury is estimated to issue about $2 trillion in debt. So that's a lot of supply for a treasury market whose overall size is about $23 trillion. So the expectation, I think, is for rates to go higher. And I think that's not hard to see. And we have an enormous amount of supply coming online. So that I think that the overall expectation would be just higher rates because of those factors.
Gotcha. And then the overall 10-year treasury, that's interesting because you said before the Fed was buying 80 billion a year, right? So
a month, actually.
A month. Sorry, that's
insane.
a lot.
Yeah, it's a big number.
Yeah, a huge number. Why did they stop buying? And then why would the Fed buy 80 billion a month?
So
because the treasury is basically, let's say the government spending, like, okay, we're gonna do a big package on healthcare or whatever, like and that's created the debt, right? And that's what the issue of a treasury is. And then if government's already borrowing money, how could Fed buy the debt? How does that work?
So you could actually think of it another way. So let's say the government, this is an emergency, COVID emergency, I'm going to spend, $1 trillion in emergency spending.
Yeah.
Okay. Then I issue debt, Fed buys it, right? So Fed sends the government cash and the government spends it. So you
Gotcha.
put it all together, you can think of it as the government basically just printed a bunch of money out of thin air to buy stuff.
Yeah,
And
gotcha.
when you do that for like $3 trillion, which is what we did, you get inflation, right? It's
Right.
very simple. Print $1 trillion, spend money, inflation. So that's kind of what happening in the economy.
Mm.
Now, the Fed did this because one, it wanted to be a team player and support what was perceived as an emergency.
Yeah.
And two, it wanted to keep longer term interest rates low, just to stimulate the economy. And it did that. And then it realized, well, the economy is doing okay. In fact, we have enormous inflation. Nobody can find people to hire. Housing prices going up 20, 30% a year.
Right.
We don't really need to do this emergency stimulus anymore. Okay.
Right. Right.
So their intention is to make rates go higher to cool things down.
Right.